Planning for estate taxes in 2011 and 2012. Fundamental changes in effect for 2011 and 2012 present both an opportunity and a challenge when it comes to planning an estate. That makes it more important than ever to understand the basics. There are three types of federal taxes that may be imposed when property is transferred from one person to another, either during life or at death. Referred to collectively as transfer taxes, these taxes are the gift tax, the estate tax, and the generation-skipping transfer tax. Transfer taxes are imposed on the federal level and also at the state level. Generally, state estate taxes can affect smaller estates, so it's important for you to get information on any state transfer taxes that may apply. On the federal level, if you transfer property to another person during your lifetime, the transfer may be subject to gift tax. The reason there's a gift tax is to prevent individuals from avoiding the estate tax by giving all their property away before they die. The gift tax doesn't apply to every lifetime gift, though. For example, in 2011, you can give up to $13,000 to as many individuals as you want gift tax-free under the annual gift tax exclusion. In addition, you're entitled to an exemption amount that can be applied against the combined total of the lifetime gifts that you make, as well as your estate. That amount is $5 million in 2011. And in 2012, the $5 million exemption will be increased for inflation. That's the largest exemption that has ever been allowed in the history of the federal gift and estate tax. But that amount is set to drop to $1 million in 2013. And for 2011 and 2012, there's a new feature of the exemption that is potentially very important to married couples. The exemption is portable. That means that any portion of the exemption that is not used by a deceased spouse can be transferred to the surviving spouse. So for 2011 and 2012, spouses can together pass along up to $10 million tax-free. Portability is scheduled to expire in 2013, however, unless Congress passes a new law extending this feature. The third piece of the transfer tax system that we need to mention is the generation-skipping transfer tax. In the world of estate planning, someone who is more than one generation below you, for example a grandchild or great-grandchild, is referred to as a skip person. If property is transferred either during life or at death to a skip person, then the transfer is subject to generation-skipping transfer tax, which is imposed in addition to gift tax or estate tax. The reason there's a generation-skipping transfer tax is to prevent individuals from avoiding estate tax on the intermediate or skipped generation. Because the generation-skipping transfer tax is a separate tax, you get a separate exemption. The exemption for generation-skipping transfer tax purposes is also $5 million in 2011. The $5 million amount will be indexed for inflation in 2012. But just as with the gift and estate tax exemption, this amount is scheduled to drop to $1 million in 2013. Unlike the gift and estate tax exemption, though, the GST tax exemption is not portable. Remember, these rules apply only for 2011 and 2012. What will happen beyond 2012? No one knows for sure, but it may be wise to review your current estate plan and revise it if necessary. If you have concerns about your estate plan, don't hesitate to ask questions and get expert help.